This is the Business Risk Index, powered by Creditor Watch. Your monthly insights into the health of Australian businesses by region and industry. Download the latest Business Risk Index at creditorwatch.com.au/Business Risk Index.
Hello and welcome to our May 2023 Business Risk Index results. I'm Michael Pollock, Head of Content at Creditor Watch, and I'm joined today by our Chief Economist, Annika Thompson. Hello, Annika.
Hi, Michael.
Great to see you again. Okay, so let's just kick off our discussion of the results. Obviously, we're seeing a deterioration in our key indicators across the board. Could you just sort of take us through that, please?
Yeah, I guess the standouts for me are, the continuing increase in credit inquiries. That metric is on a clear increasing trend, and we've got 2.5 times the number of credit inquiries this month than the same month last year. So that tells us that businesses are either accepting a lot more credit applications, which in one hand is concerning, but also they might be making more credit inquiries or more frequent credit inquiries on some of their customers if they're a little bit unsure as to their financial viability. So usually when we see that indicator rise in a market, in economic conditions such as this, it indicates that a lot more customers are doing their due diligence.
Okay, and looking on the industry side, we're obviously seeing pressure coming to bear on the hospitality industry, food and beverage services, as interest rates bite, people tighten their belts, discretionary spending is reduced. What else are we seeing there on the industry side of things?
Yeah, well, the food and beverage sector has always been the top of our list for probability of default by industry. But they're actually experiencing quite good conditions in the first sort of quarter or first half of this year, even with lots of people still eating out, and turnover in the food and beverage sector still quite good and still positive. It was only last month actually where that indicator in terms of retail trade data turned negative. So that's really concerning because they've always been the top of our list for probability of default, and now their trading conditions are getting worse, and they're going to get much worse as the year progresses. The other area of concern for us now is the retail trade sector. So again, they saw boom conditions after lockdowns ended, particularly in New South Wales and Victoria, whereas a lot of payback spending, that's well and truly over. And now, the savings rate and the discretionary spend that a lot of households have has been wiped out through interest rate rises and rental increases as well.
And obviously the construction industry continues to see external administrations go up there.
Yeah, look, we haven't had a big name sort of construction firm become insolvent over the last month or so, but there's still a number of smaller, the sort of subcontractor end that don't necessarily make the papers who are going into insolvency day in, day out, and that is one of the industries that is a big concern. And they've got a similar trend to the food and beverage sector where they've been very, very busy, so workload hasn't been a problem. But, we're getting to the end of the cycle now where the massive number of houses that started being built and the massive number of renovations that started happening over COVID are now reaching their conclusion. And because of the cost of building a house and doing a renovation, their workload or their forward work orders will be severely constrained. So that's going to add further pressure on the construction industry.
And project times are blowing out too, I believe. So it's taking that much longer for builders to complete projects, which is
absolutely. And time is money, and we know the cost of labour is going up. So the longer it takes, the more labour cost that they have to, the bigger labour costs they have to wear that they probably didn't budget for at the start of the project. So and while construction supplies, or the cost of construction supplies, or the rate of increase is going down, the cost is still increasing, and I think that sort of fact often gets lost. And the cost to build a house today versus what it was in the end of 2019 before COVID is significantly different. So we've still got contracts that were entered into in 2020 that are being worked through at far different, supply input costs that they're having to deal with.
Yeah, sure. Tough times.
Mm-hmm.
So looking at our geographic insights for May, we ran an analysis of our biggest moving regions up and down the index over the last 12 months, and that spat out some interesting data in terms of regions that are under stress at the moment. So what we identified was that three of the worst five movers down the index were actually all adjoining on the central coast of New South Wales. That was Wyong, Gosford and Lower Hunter. Now, Gosford and Wyong in particular have had a drop in property prices. A drop in property prices, but an increase in listings, indicating mortgage stress in those areas. What else are we seeing going on in those areas, Annika?
Yeah, it's an interesting phenomenon because, while unemployment's really low and there's still, a high number of jobs available in those areas, they tend to be at the lower paid end of the job spectrum. So the biggest employers in those areas are health and community assistance, retail trade and construction. And while there's lots of jobs available in those areas, the rate of pay or the pay increase that you can get is just not keeping up with mortgage increases and also rent increases as well. So that's probably where the stress is coming from. And this is the awful thing about inflation and why the RBA is so keen on getting it out of our economy through the pain of interest rate rises, is that it's the lower paid people, that bear the brunt of it. They just can't get the wage increases to keep up with the cost increases, whereas people, who work in professional services or things like that, they can often take on a bit more work, and the work that they take on is more highly paid, so they can keep up with those cost increases a little bit easier.
Sure. And Casey in Victoria was another example that crept into our top 10 worst performing regions for the first time, and that is also seeing a fall in property prices, but an increase in listings. So it seems to be a pattern that really has an impact on people in those particular areas, unfortunately.
Yeah, well, Casey's an area where a lot of residential housing subdivisions, so a lot of people in those areas would be very early into their home loan journey, maybe on a fixed rate that started 2 years ago, that on a very low interest rate. Coming off that fixed rate, they'll notice an enormous jump in their home loan repayments, but not the equivalent increase in their income. So that's where the stress comes from.
Sure. All right, thanks for that, Annika. Always very interesting to go through the numbers with you. If you would like more data from our Business Risk Index, which includes our interactive map that covers more than 350 regions around Australia, you can find that at creditorwatch.com.au/business risk index. Thank you again, Annika, and we will see you next time.
Thanks, Michael.
Creditor Watch is Australia's largest credit reporting bureau for SMEs and corporates. Download the latest Business Risk Index at creditorwatch.com.au/business risk index.